Joining me now for a closer look at what's playing itself out in that market scene is Sithembile Bopela from Ashburton Investments. Sithembile, always a pleasure, and a good afternoon to you.
Very good afternoon to you and your viewers.
All right, I think the US and the UK, or Europe, UK, are meant to be back online today, actually. I'm keen to find out if we've already seen some of that playing itself out in the markets. It is a bit of a mixed bag this afternoon.
Yeah, so I think the market has started off on a positive note, but we have seen already some pullback from the open, which, I mean, I think we could see similar moves to what we saw yesterday play out again today. Again, as you mentioned, yesterday it was thin volumes from the US and the being away for a public holiday, but today we're seeing, I mean, much of the weakness coming from the resources, which were yesterday's winners. So perhaps a bit of profit taking there. But in general, I think the market is definitely, there's quite a bit of caution ahead of, key risk events this week. Definitely the elections tomorrow, but also the SARB, the SARB's decision, interest rate decision tomorrow, but also, I think the markets are also keeping an eye on inflation from the US, the PCE numbers coming out on Friday. That report's likely to give some indication of where the Fed might be going in terms of its interest rate trajectory. Again, that's just the path of interest rates in the near to medium term, I think is quite polarized at this point in time. But yeah, I think it's quite a week for markets to grapple with. So those are some of the main things that investors are grappling with right now.
We are seeing the rand weakening a bit. It's at 1841. And of course, we saw it last week in the early 18s. I'm keen just to get your thoughts on that one. We are seeing more hawkish commentary still coming out of the US, but Europe dovish, I think, at this point.
Yeah, so I think the rand is responding to, again, some of that caution coming through from, the fact that we do have elections coming through, elections on tomorrow. And so generally we do see, markets respond quite cautiously leading up to the event. And so we are seeing that reflected definitely in equity markets, but also in currency markets as well. Minutes from the Fed last week were quite hawkish in the sense that, the committee showed its dedication to bringing back inflation towards that 2% target, even if it requires further interest rate hikes. And so it was quite hawkish commentary from the Fed. And I think, as much as the latest data has been indicating some sort of cooling in the labor markets and in inflation as well, I think definitely the market's expectations have barely moved, given the fact that, again, the rhetoric has been quite hawkish, with most analysts expecting, the cutting cycle to start in September versus the previous expectations for, the cycle to start in June or even in July. And I think there's also been in the SA sort of context, the MPC is meeting on Thursday, and so it is the day after the elections, and so I think again it's quite a lot for markets to kind of digest, and that is playing out in the rand because we are seeing that as much as we are also in line with consensus that interest rates will likely be unchanged at this round, I think there is still quite a bit of caution as to when will interest rates actually start. The cutting cycle, when will it actually start? And also just the quantum of the cutting cycle is, I think, a huge risk factor at this point in time.
Keen to get into some company news with you now, maybe looking at Pepco reporting a 3% decline in profits. But I think what's interesting here is that where they are seeing green shoots is fintech. And I guess this is a good time to be a seller of debt.
Definitely. I think, yeah, definitely in a market where, consumer disposable income is under strain. Consumers are definitely leaning into credit, leaning into and that's reflected in sort of positive credit sales across the retailers. In fact, I think obviously the experience is different across the board, but yeah, I think for Pepco, definitely the bottom line performance was, as much as it was quite mixed, from a normalized perspective, headline earnings per share was quite robust, underpinned by, supportive margin expansion and robust sales. And that, of course, coming through from the credit component,
Let's
which was positive for them.
Let's also talk Raynet. I think 8% increase that we're seeing there in their net asset value. I think it's very interesting how their pension insurance corporation business, I think that continues to really deliver for them, just considering also that many holdcos like Raynet aren't reporting quite as a robust increase in their NAV.
Yeah, I think generally that is the sort of constraints when it comes to holding companies, is that they do tend to trade at very deep discounts to their net asset value. And so seeing this improvement in the NAV for Raynet was quite positive, especially seeing, the unlisted components delivering for them, because I think that's part of the argument for holding companies, right, is that you get exposure to these unlisted entities that you wouldn't, as an investor, necessarily get direct access to, given the liquidity requirements. And so I think, this was quite a positive sort of indication from them.
Another interesting one coming out today, not so much market news, but I'm just keen to get your thoughts on it. Discovery Bank starting to really market their home loan business very hard. Of course, this is a new place where Discovery can compete. I'm wondering, Sithembile, in your opinion, if this could actually disrupt the market, if Discovery could actually take on a lot of home loans from traditional banks and really maybe change the competitiveness within the home loan market.
Yeah, I think it's likely to remain a very competitive space, definitely, and especially given prevailing macros across, the South African economy. I think for Discovery specifically, they are a very innovative company. They've been pursuing, these growth ventures, and so I think it's very on brand for them to pursue this and to pursue it this aggressively. They've shown very positive execution success in their past endeavors as well, and so I think that's likely to be a positive underpin for them going into this specific venture. I think they are likely to perhaps, there'll likely be some growing pains in the near term, but I think it is positive for them in terms of increasing their main banked clientele through this offering, which I think that's definitely the clientele that they are sort of hunting or rather targeting initially before expanding to the rest of the market. And so I think it would be very interesting to see how it plays out, but I do think it's definitely going to have an impact on the broader sector, definitely.
Well, Sithembile, I'm keen to get into our stock pick segment now, but first I'd like us to reflect on counters that have found favor with your industry peers.
So mine is, I'm not sure how well known it is, but it's a global US-based insurer called Kinsale Capital, and they focus on a niche of it's called excess and supply. So they focus on insuring the area where not a lot of insurance is, there's not a lot of standardized insurance, so it's quite unique. They've got a very robust business model, and they use a lot of analytics and data in their pricing. They've probably got one of the best claims ratios of all the insurers in the world at around 75%. It's a real consistent compounder. It's one of those that it just churns year in, year out, superior returns relative to the peer group. So it's a great little opportunity. It's a great business, and I think it's one worth owning.
It's the China Internet ETF, code KWEB. And really what you're doing here is you're getting an ETF that gives you exposure to the leading Chinese tech companies. So you've got Alibaba, Tencent, JD, and the likes all in there. And I think why you would look at this is that there are clear signals that the Chinese economy is improving. It's got a long way to go, but the signs are there. It also looks like regulation is easing, sentiment is starting to improve there. And you're getting the Chinese market and tech, particularly from a comparative basis with US tech, at extremely attractive valuations. It's not correlated to how those other tech companies move, and the fundamentals are there. So we think, despite what is going to be a noisy geopolitical landscape with the US elections coming in, we think this is a very compelling buying opportunity into China, and the sharp end of the stick there is tech.
My stock pick today will be We Buy Cars. And sticking to the theme of high interest rates, I think people do not have a lot of cash to be buying new vehicles. So there is a lot of potential growth in the second-hand market. And the fact that, they just recently listed, that is a positive sign in terms of the business is growing. They're looking to expand. So it's a stock to look out for. Quite risky because it just listed recently. But I do think there is some positive ground to see there.
All right, Sithembile, keen to get your thoughts on some of those. Kinsale Capital, We Buy Cars, and the Crane Shares CSI China Internet ETF.
All right, so Kinsale Capital, I must be honest, it's not a stock that I've looked at in any detail. So, I mean, it does, from what I've seen, it does screen quite well compared to peers. But again, I just couldn't argue for or against it without, understanding the fundamentals of that business. So perhaps a bit of homework, thanks to Grant. But in terms of China, the Chinese ETF, the internet ETF, I think the China story has become quite polarizing, with one camp, thinking that China is no longer the new black, or, that China is in a transitionary period back towards growth. I find myself in the latter. And so, I favor Chinese stocks at these current levels. I think the market is quite cheap. Valuations are very attractive. And, while we do expect to see some near-term pains, but, for the longer-term investor, I think it's a very attractive. These are very attractive entry points for, especially into tech players, which I think, definitely still have quite a lot of runway. We Buy Cars, I think the stock has definitely done quite well since its listing. Very prudent for TCP to sort of decouple it from, its legacy issues. But, it's another story. I think they definitely are, strongly performing business from the results that we saw previously. They did show, some positive momentum from earlier updates as well. And I think, they've definitely been, showed continuous efforts in terms of enhancing and investing in, innovation and specifically the digital business platform. I think that's likely to be a very strong underpin for them in terms of its growth prospects, despite the challenging, I think, market dynamics within the second-hand vehicle space.
With that said, which counts are you loving this afternoon?
Again, sticking with the China theme, I do like, as I mentioned, valuations are quite attractive at these levels. So I've been looking at BYD. The stock is, it looks very undemanding at current multiples relative to where the stock has traded previously. I like thematically the adoption of new energy vehicles in China, with the rest of the world also playing catch up. BYD's dominance, they've established themselves within that market, the NAV auto market, and I think that positions the business very well for growth. Operationally, they've got a scale advantage, competitive advantage, in the sense that they make cheaper, safer lithium iron phosphate batteries, which could help the company, seal supply deals with more EV makers that are looking for cost-effective options, while at the same time wanting to diversify their operations. So, yeah.
Brilliant, Tay. Thank you for your time today. It's always a pleasure having you with us. That was your midday markets update with Ashburton's Sithembile Bopela.